So today I have the pleasure to interview Brian Chen, one of my colleague lender that I work with. So because of the rate increase, and I want to be able to give you guys a little bit more updates on the mortgage side. So I want to have Brian to talk to us and give us some update in the lending industry and what we're going for. So Brian.
Yes.
Hi.
Hi.
Nice to have you join me to for this interview. And Brian, tell us a little bit about your company.
So I work for a company called GFL Capital Mortgage. We are based out of Sacramento, California. Company's been around for, this is going to be the 15th year. So it's been around for a while.
How long you been?
I have worked for GFL Capital since 2010, so 12 years. And my first job out of college was actually for a different wholesale bank, mortgage bank, in 2004. So
Okay.
I've kind of been around for a while here. I've seen the ups and the downs, and
That's a good thing,
Yeah.
because right now we're seeing interest rate, because there's an increase of 0.75
basis points.
basis
Yep.
points.
Yeah.
So it's been going up, consistently, is nonstop for these couple months, and a lot of buyers have, concerned. So you've been around, and we have goods in 2020 and 2021. So tell us what are we looking towards, with these high rates are going up, like what we're expecting.
So I think, rates, like you said, have been going up pretty much all year. They've doubled since the beginning of the year, which has caused a lot of home buyers that were looking to buy houses to either pay more for the same house or have to readjust the purchase price of the houses that they're looking at and look for cheaper homes. So what I personally noticed is that I have a lot more people that I talked to at the beginning of the year deciding to just kind of wait it out and see, kind of either if rates come down or if home prices come down. They just kind of want to wait and see, take a wait and see approach. It's certainly not like the last couple years where rates, were low and everyone was bidding against one another. It seems like it's becoming more of a buyer's market, which is good. But at the same time, buyers are going to be paying a little bit more per month for that same house. Yeah.
So Brian, for a lot of consumer here concerning about rate jumps, what are one of the products that you can advise for your clients?
Yeah, so adjustable rate mortgages have become more popular in the last 6 months or so. Seems like with interest rates going up for the 30-year fixed loan, and it just makes it harder for people to qualify.
Anything that helps, right?
Pretty much, yeah. Anything that keeps your payment down, So that's kind of what seems to be becoming more popular now.
Because like if it's 5 years and if the rate, go down, then you can refi.
Yep.
Right? So with the rate, do you have an estimate of what the...
You're probably looking somewhere like, depending on how long the fixed period is, if it's 5 years or 10 years, you're probably looking somewhere, 5.375 to 5.625 would be my guess. Somewhere in that range. So yeah, it allows you to buy more house, qualify for a lower payment.
And you can also use the buy down option to
Yeah.
lower the adjustable.
Yeah, you can. Yep, you can pay points to lower the interest rate if you wanted to, or if you can get a seller to give you some credit and have the seller pay for your buy down. Certainly, that's an option too. So
right now, I heard that there's an option of rate buy downs because the rate jump increasingly every time the Fed want to increase. And tell us a little bit about the rate buy down, because it was now started coming back. And
yeah, so like rate buy downs it's always an option that the consumer has to pay points or fees to buy their rate down to a lower rate. So if interest rates are 6% today, you could buy it down to 5% or 4% or 5.5%, whatever. You could if you want to pay enough money, you can buy your rate down. When rates were in a really low environment where
like sell the markets, I don't think there's a possibility, right?
Well, yeah, it's I would say the last couple of years with rates being really low, it didn't make sense for a consumer to pay points to lower their rate, because you weren't saving a whole lot of money to do it. Your money was better used buying furniture, just saving it for a rainy day in case your water heater goes out or something. But now I think with rates going up so much, it's something to at least look at. If I was just talking to a client today, and she was looking at homes that were like $500,000, and before she was able to afford houses that were like $530,000. And I said, okay, well, if you want to keep your payment the same, use some of your money and buy down the rate. Pay 1 point, 2 points to buy down your rate. Keep your payment still in that same $3,000 a month range, and you can get that $530,000 house that you were. Buy downs is always an option that the consumer has to pay points or fees to buy their rate down to a lower rate. So if interest rates are 6% today, you could buy it down to 5% or 4% or 5.5%, whatever. You could if you want to pay enough money, you can buy your rate down. When rates were in a really low environment where
like sell the markets, I don't think there's a possibility, right?
Well, yeah, it's I would say the last couple of years with rates being really low, it didn't make sense for a consumer to pay points to lower their rate, because you weren't saving a whole lot of money to do it. Your money was better used buying furniture, just saving it for a rainy day in case your water heater goes out or something. But now I think with rates going up so much, it's something to at least look at. If I was just talking to a client today, and she was looking at homes that were like $500,000, and before she was able to afford houses that were like $530,000. And I said, okay, well, if you want to keep your payment the same, use some of your money and buy down the rate. Pay 1 point, 2 points to buy down your rate. Keep your payment still in that same $3,000 a month range, and you can get that $530,000 house that you were that you really wanted, right? So it doesn't always work out. It's just something to always ask your lender, just to have all the options available to you.
As far as this market right now, because we have so much inventories and some of the house stays on the market quite some times, I think buyer have some opportunities actually can be able to negotiate seller credits, right?
Yep.
To utilize it to do a rate buy down or for closing costs.
Yeah.
So yeah. I think that can be a negotiations now, the flexibility for buyer at this moment.
Yeah.
Because of the market.
To really look at the house. If you really like the house, buy the house. If you can afford the payment, if rates are over 6%. They won't always be over 6%. Eventually, rates are going to come back down. And I feel like if you were to buy the house now with less competition, because you have a lot of, the hardest part is getting the house. And that's why I think, talking to a realtor and making sure that you're putting in a competitive offer is something that's really important right now. And if you can get that house now, certainly go for it. Don't be afraid of the higher interest rates.
And plus, through my experience, is basically, you would have to justify neighborhood by neighborhoods, because not all homes are the same, and some homes do sell quicker than others. So, really depends on areas as far. So, Brian, are we going towards a market crash?
Personally, I do not think we are going to have a crash. There, for a few different reasons, we still have a shortage of housing. And in the grand scheme of things, we've not built enough houses.
Not there yet.
Yeah.
Right.
Homeowners have a lot more equity than they did in 2008. There's no, 80, 20, 100% loans out there.
And you did refi. You did a lot of refi. That's
we
yours,
did,
right?
Yeah.
So with a low rate with 2%. So,
well, that too, right? Yeah. So a lot of people that may have had trouble making their payments over the last couple of years because of COVID and the pandemic. Their house has only gone up in value, so they have no reason to just give it to the bank and foreclose on the house. They can sell it for current market, pay their fees, and probably still walk away with a profit. that you wouldn't be able to do in 2008. A lot of the loans now are fixed rate loans. So, you know, the payment is going to be fixed for the next 30 years. It's a stable loan. Whereas in 2008, you had a lot of adjustable rate loans, interest only loans, stuff that had balloon payments. So where, you know, people got stuck with these higher payments that they couldn't afford, and then they were forced to sell or walk away from their house. So I don't think we're going to have a crash. I do think that we are going to have a slowdown, and I'm sure you've noticed it, you know, in this market already. This home prices either having to be cut or homes sitting on the market longer.
We do see a little shift, a little difference, but I mean, it's predicted. You know, we basically working in this industry full time, so we know the ups and downs, and we know the in and out. So for us telling there's no market, you know, crash or bubble, and obviously is by all the datas and trends and everything that we see. So, and one of the things that I have discussions regarding with a lot of consumer that decide not to buy and want to rent, what would you recommend them to buy or rent at this moment, at this current market?
Oh, I think with the inflation going up and, you know, rents continuing to go up, you're just paying someone else's mortgage for them. So the dollar just being weaker doesn't really help a renter so much. If you can afford it and you find a house that you like, I think, you know, it's always a good time to buy. You know, it's just finding the right house and making sure you're comfortable with the payment. Just don't buy any house, but I think it's always a better option to buy than to rent.
You know, obviously down payment assistance can help for a lot of homeowners, and you know, rates, we can't really talk about rate because we cannot control it. But down payment assistance, tell us a little bit about the requirement for down payment assistance. How can you qualify?
Yeah, so the most popular down payment assistance program, it's the CalHFA loan. It's a loan program that you can either do a conventional loan or an FHA loan for. Basically what it does is it allows the homeowner, first-time home buyer, to take out a loan for, say, 96.5% if they go with an FHA loan. They could take out a second mortgage for up to 3.5% for the down payment. So, you know, come up with very little out of pocket there. I think there's a maximum of like $14,000 that can be used for that second mortgage, but depending on how expensive of a house you're looking at, you might not even exceed that. And then they also have a potential third mortgage option that could help cover closing costs up to, you know, 2% of the sales price. So it allows a first-time home buyer to purchase a home with very little money out of pocket. It's certainly a good program to help get you into that house, and from there, you know, hopefully home values continue to appreciate, and you could always look to refinance it later, you know, down the road.
Yeah, if you have a down payment for closing costs, you definitely can be able to negotiate seller credit for the rate buy down.
Yep, so, that's always an option also.
Yeah, you know, so that's a win-win.
Yeah, so a little bit about the CalHFA program. There are income limits depending on the county that you're looking at. Sacramento County just increased their loan limits to $202,000. Oh. They do have a maximum debt to income ratio that has been increased to 50% of your pre-tax income can go towards expenses as long as your credit score is over 700. And if it's your credit score is between 640 and 700, it's 45%. That hasn't changed.
So what kind of documents and requirement do you need?
So with those programs, yeah, you basically are, if you're W-2 wage earner, you're just going to need pay stubs and W-2s, copy of your driver's license. If you're self-employed, they're going to want to look at tax returns depending on how many years you've been, you know, you've had the business. More than likely, you're going to need 2 years tax returns. So it's pretty standard in terms of like the documentation that you would need, as the same as if you had 20% down, you know, for a house. The bank's still going to want to verify your income to make sure that you can afford to repay the mortgage.
Any other programs that you advise?
For owner-occupied, I probably would say, you know, you got your FHA loans, your conventional loans, your adjustable rates, and your fixed rates. I'd say for investors, you have your debt service coverage ratio loans where the rent just has to cover the mortgage payment. And sometimes it doesn't even need to cover the mortgage payment to get a loan. You have your bank statement loans where the bank will look at 12 months or 24 months bank statements, just kind of look at the deposits. You've got your no ratio loans where they don't really even look at all of that, So it's just, there's lots of different types of loans.
There's so much options, right?
There are a lot of
options. Depends on
options.
your scenario, depends on your personal scenarios, and obviously you would have to really run through the numbers and run through your scenario to know what would be the best options and programs for you. So if you're thinking and want to look into buying, definitely plan ahead and just have a portfolio and just look through it to see what will your path, your interest rate, your credit score, get everything prepared, and then when you're ready to buy, then you have me, you have Brian, and all of our professionals to help you, to guide you through the process.
Yep.
So with all these informations, I really want to know what's your future predictions of what the markets, what we're heading towards in terms of the mortgage and the lending side. What you will see.
I think that eventually rates will get better. It might be a little rocky for the rest of the year. It really comes down to how much more the Fed is going to raise rates. That's part of it. How fast can they combat inflation, which is obviously hitting everyone's pocketbook one way or the other. We're going to the grocery store, buying gas, So the sooner that the Fed can kind of combat that, I think it'll be, that'll kind of give us a timeline of when things might start to get a little bit better and when we might see the light at the end of the tunnel. But personally, I don't think, we'll see anything really until the end of the year, if not next year. So kind of buckle up and be ready.
On the ride.
Yeah.
So you're saying if the inflation's kind of, control, the Fed will kind of decide to drop the rate a little bit?
Well, I think, what will end up happening is, they'll start to slow down the rise in rates. And I think
just calm down.
Just kind of we just want normalcy, I think, more than anything else. And right now I don't think we are anywhere near that, personally. So
I just feel like just like a wave just keep going up and nonstop. So. So okay. So thank you guys. Great information about the mortgage side. So I hope you guys can grab a little bit of updates and hope to see you on the next episode, on the next video.
Thank you for having me.
Thank you. Thank you, Brian.